From the morning reading, the Spiders and Diamonds' new all-time high following a late rally on Friday. The Qs and IWM are in a bull flag pattern. Breadth strengthened compared to the prior session and leads 1549 to 1444 on the New York Stock Exchange. Decliners led 1524 to 1317 on the NASDAQ. In the S&P 500 snapshot, record highs continue. On Friday, the S&P opened lower than the previous 3 days and oscillated around a narrow range until late in the day, with a few jumps just before the close. The index reached its intraday high at the close and ended the day with a gain of 0.15%. Week over week, the index saw a gain of 0.70%, ending Friday with another record close. U.S. Treasury puts the closing yield at the 10-year note at 2.31%, down from the previous Friday close. In other news, negative studies keep falling. Most of the indicators and patterns we've looked at since December suggest a poor risk-reward for stocks, and yet they've climbed steadily higher. We went back over every study and recorded other dates that bucked a cluster of negative studies and see that longer-term returns going forward were significantly positive. Media is hopping on the melt-up. Mentions of the market melt-up have skyrocketed recently to the highest level ever seen. Even during 2013 and 2014, when a number of mentions of a melt-up started going parabolic, stocks took a shorter-term breather every time. Once again, volume was negative. On Thursday, we looked at the dates when the Dow closed at a new high, but less than 40% of volume in the New York Stock Exchange went into advancing stocks. It happened again on Friday. The only time in 60 years we've seen a cluster like this was in November of 2014. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:55 a.m. Mountain Time, and I'm recording this in preparation for the market day, February the 27th, 2017. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and bounce over to the morning report. And at the time of this cut, a bit of negativity, but nothing of significance. All four of the U.S. broad-based indices were down just below scratch. Crude oil's up about 0.75%, Euro's up just above scratch, and long bonds and gold are also rotating just below scratch. China is down about 0.75%, Hong Kong just below scratch, Japan down almost 1%, Germany and United Kingdom just above scratch. In terms of macroeconomic reports for today, of note for the United States, you have core durable goods, pending home sales, and FOMC member Kaplan speaking later today. And looking forward to tomorrow for significant items on the U.S. preliminary GDP, Chicago PMI, consumer confidence, and that looks to be about it. But that actually is a fairly significant list for the beginning of the week, so keep that in mind. In terms of current volatility conditions, short-term VIX 9.41, skew 138.66, and then let's see, IV percentiles still very, very low. The S&P a 13, the RUT a 16, the NASDAQ a 9, and the Dow a 22. No standard deviation size moves were put in on Friday on a close-to-close basis. In fact, it was pretty much a doji. In fact, we'll go ahead and go to the charts now. And you see the S&P, we actually, in last night's overnight session, did set another intraday new all-time high. Friday's candle you see here is essentially a doji or hammer. It's a pretty small body there. And you see after the recent break up, we've essentially gone into a sideways pattern of indecision in the back half of last week. So perhaps some signs of some exhaustion or at least consolidation, and kind of absorbing that most recent move. In terms of the Dow, also a very similar pattern over here, a breakup and most recent breakup, and then kind of into a sideways pattern, and the end of last week. NASDAQ, as one of the morning authors mentioned, has set up into a bull flag pattern. And this is kind of interesting. You get the breakout and then come back and test the previous area of resistance, and bounce off of that with Friday's action, and setting up that potential bull flag continuation pattern. And the Russell also in a flag pattern, though I'm not as enamored with this pattern as I perhaps might be of the NASDAQ. We had the breakout of the previous range on the Russell. It came back, kind of undercut, surged again to a new all-time high, but then has faded ever since then. Right back now, we've had a couple sessions, inside the prior range. So right now we're trying to determine, is this truly a breakout, or is this just a head fake and back and settling into this prior range once again? The more time it spends underneath that area, the more likely it is to just simply settle back into the prior range and basically nullify the breakout activity. We'll see. In terms of other markets, crude oil continues to chatter near the upper range, the upper limit of its recent trading range that goes back over 2 months now. It's trying to push. We've had a couple false breakouts just to close back down into the range. We'll see if we can finally break through that area and move. Gold has been continuing its bullish short to intermediate term trend. We'll take a look at the dollar. Dollar is neutral, really, and as about a neutral pattern as you could get of late. Very much in the center of the cloud and in a consolidation pattern, kind of a sloppy sideways consolidation pattern. So not a lot of indication from the dollar, either bullish or bearish at this point. Once the dollar does make a breakout, we'll likely see those moves in crude oil, gold, and in bonds start to become a bit more clear. And you see the long bonds also in a sideways pattern. Continues. We continue to get this bit of a symmetrical triangle pattern. The overall posture in the middle of the cloud also quite neutral. And volatility continues to be extremely low. We're still below a 12, and anything below a 12 is just extremely low, and we don't price in any expectation when these volatilities are that low of any big moves in the market up or down. In terms of the daily report, a few changes here and there, not a lot. Market phase 4, this is a bullish extension pattern type of phase. The 3 market timing signals, the first one from IBD, confirmed uptrend, still continues. That's bullish. GMI index also still a perfect 6 out of 6. That continues its bullish signal that's been in place since 11:10. And then stock charts, decision point scoreboard, no changes from the last time we broadcast. Still very nice stack on the short to intermediate term, but mixed signals coming in on the long term across multiple index. Position sizing opinions remain at 100%. Intermediate term market postures remain exceptionally strong bulls, and they're further supported by strong bull sentiment lines. And you see 3 of the 4 indices are up over 95, so they're just about as high as they can get. Russell is still an exceptionally strong bull, big recovery in the last couple weeks, and yet continues to be relatively weaker than the others, but don't make too much of that. It's still an 87.2. That's an exceptionally strong bull intermediate term market posture in its own right. Strength of trend is still very good. Nothing of question there. Hedge warning status remains 0+, normal with some elevated conditions. In terms of the strategy opinions, we continue another week with the covered call strategies at the 1-to-1 ratio. with these expansion patterns and some signs of exhaustion and so forth, very hard to get too aggressive with the construction of the covered calls. Obviously, when you do get pullbacks, that presents opportunities for put selling. And then also with option income strategies, consider that the VIX below a 12 is not a terribly rewarding area to initiate new positions if you're a novice trader. So that's a bit of a caution there. In terms of specific areas of warning, we did have a volatility ratio warning fire with Friday's session, and we have seen in some recent volatility price action that we've seen some positive correlation between the equities, specifically the S&P, and the volatility going up at the same time, which is a bit unusual. But also keep in mind in context that volatility is at exceptionally low areas below a 12. So a lot of this is probably just noise. We'll continue to watch it and see if it develops and starts to accelerate that that pattern. But as it stands right now, these are very, very minor warnings. Even the distribution day count, has finally fallen below warning level for the NASDAQ. Skew is a bit elevated, and there certainly are probably some people who are doing some put protection of profits that have been earned since the election. So none of these are terribly concerning in themselves at this point. Under the trend-based area, there's nothing of concern here. Intermarket risk aversion indicators, we have some weak risk-off indicators, and so certainly that's another thing that we will continue to watch and see if that angle in separation starts to accelerate. But these have been largely neutral in recent weeks, kind of wrapped around each other, and at times barely risk on, at times barely risk off, at other times you can't even separate the lines without a magnifying glass. So these are probably best read as neutral at this point. Sentiment a little bit escalated in terms of stocks intermediate term, and you see the fear and greed index a 68, so relatively high in the greed area, but certainly we came down from the extreme greed that we were seeing in parts of last week, so scrubbing off some of that excess sentiment. In terms of sector specific, you see Friday did eke out a positive day, and frankly, overall, most of these were pretty good breadth. All but two sectors had good breadth. The two sectors that were lacking were financials and energy. And financials, there's probably been some profit taking there of late. Now, we will have some news come out this week, which will likely be significant. You got the president who will be speaking. And it would seem is going to be including as part of his discussion some tax reform concepts, and that likely could be a tax, that could be a market mover. And then you also have the first Friday of the month employment report coming out later this week. So there certainly is at least a couple major market potentially moving news items on the docket for this week. Now, the other thing I would mention is that while we've got both risk on and risk off, we do seem to see of late a little bit more attention being paid for the defensive sectors. So while people may be still pouring some money into the market at these levels, they more often than not in recent sessions seem to be pouring it into defensive sectors. And you see utilities up here, telecom also defensive, consumer staples as well, generally thought of as being pretty defensive, real estate also. So a number of these that could be seen as interest rate sensitive or defensive sectors. These are also the source of dividend paying stocks oftentimes, continue to do pretty well. We can see that as we come down here to the percent change. You see recent performance. Let's look at the 5-day. Look at the utilities. Utilities are up 4%, and looks like they lead the week for the 5-day performance. Also, telecom, second best performance for the week. Another defensive sector. Real estate, 2.43%. So 1, 2, and 3 performance on the week, all defensive in their nature. Even the next one is consumer staples. So all the defensive sectors are in the top of the 5-day performance. So something to kind of keep in mind. Don't let those things surprise you. There's no reason for it. It's really quite obvious if you just follow the right charts. In terms of relative rotation graph, we see telecommunications has been, while in the upper right-hand quadrant, has been tailoring off. IYT also been tailoring off. Well, look at this FDN. FDN spent so long up here in the upper right quadrant, had rotated out and seems to be sneaking back up and in to this area. So FDN's been a pretty good holding for quite a few weeks in recent quarters, and it may be coming back in favor once again. You might want to pay attention to that. Also look at over here, crawling from the left-hand side, utilities, REITs, also doing an improving performance. So something to kind of keep your mind on. Okay, that's probably enough for today. Let's go ahead and wrap this thing up. And I'll slide through these slides. You see something of interest, just hit the pause button. Also, you might notice the hyperlinks to take you to additional information. And obviously the YouTube channel, the daily price guide subscriptions, the room membership, and as always, the disclaimers. If you have a need of more time to read these disclaimers, just hit the pause button. Also note the hyperlink down here at the bottom for the full set of disclosures. Manage that risk profile, and we'll see you next with the Falcon Global Market Preview, probably tomorrow. And in the meantime, good trading.